Alrighty, so here's one we got from a client recently, boss. So, what is the best way to explain an accountable plan to a client?
Yeah, the best way that I'd like to explain it is if you've ever worked for anybody and you went off and you went to, I don't know, you took a client out for lunch and you paid with your credit card, it's $58.62. You hand in that receipt to your HR people, they give you a reimbursement on your paycheck. Same exact thing. That's what an accountable plan is. It's a reimbursement for employees, and owners are counted as common law employees under this definition, and it reimburses them for personal spending that is attributable to business purposes. And so there's a lot that can be done there typically, depending on the situation, of course. But yeah, uh, if you have a separate business that's not just you as a Schedule C, but like an S corp or a partnership or whatever, and you have a home office that you're using, then the expenses that are attributable to that home office are reimbursable under an accountable plan. So people talk about the home office deduction. Home office deduction is only for Schedule C unincorporated disregarded entity businesses. And if you have a different business type, then they fall under accountable plan reimbursements. And accountable plans are more have a wider scope than just home office. But that's just one of the common things that a lot of people do. Um, so yeah, so it's just reimbursing for stuff you've already spent that has business purpose. And that's it.
Okay, it looks like someone wrote in, Neil, and said, if a client's about to sell stock or real estate, a go-to plan to reduce capital gains.
The it depends. So if we're talking about stock, then first we want to look at what kind of stock. If it's just public stock, like Apple Computer or Tesla or whatever, then your go-to move is to look at tax loss harvesting. So tax loss harvesting is when you look at other things that you have in your portfolio that are currently in loss. And you're like, well, I've got this gain. Let's say I've got $50,000 gain. I got these other losers that add up to be $30,000 that I'm down. What I'll do is I'll sell the losers. That'll offset the gain from 50 down to 20, and I'll pay long-term capital gains tax on the 20, or short-term capital gains if it's a short-term thing. So that's number one. Number two, when it comes to real estate, is well, do we have a personal use exclusion? That's always question number one. So if you live in a property for 2 out of the last 5 years, then as a single person, you get $250,000 of gains tax free. If you're a married joint, you get $500,000 gains tax free. So if you can meet that, that's always move number one. If you're less than 2 years, so let's say you have 1 year of occupancy during that 5 year period, the exclusion gets prorated down. So, it's still better than nothing. You can look at tax loss harvesting on stocks to counteract your real estate gains. That's potential. But then there's also other things to look at. So in not your average situation, but we have had clients who are heavily involved in cryptocurrency, and they have massive losses in cryptocurrency, and we can recapture or we can capture a lot of those by strategic selling of those losers. And that gets, crypto gets very complicated because back in 2013, the IRS just kind of planted a flag in the sand. They said, we're treating it as property, which I think is actually mostly correct. But there are functions in cryptocurrency that do not have an equivalent in regular property. So, like, this bottle of water, this is property, right? I cannot stake this bottle of water. I cannot put this into a liquidity pool. I cannot do a lot of things that I could do with cryptocurrency. And so the analogy kind of breaks down in those situations. But there are some interesting tricks to be done there. There are other exotic kind of plans or strategies that you can bring in when it comes to capital gains, but basically that's getting involved in third party stuff. There are syndications you can join and all those kind of things that are going to generate taxable losses or capital gain offsets, or depends on the situation. But that's very esoteric. It doesn't apply directly to the capital gain. It's just another thing you can layer in to help offset. Um, so definitely number one, number two are tax loss harvesting, and then personal use exclusion on the real estate. So yeah, that's where we start, and then it just keeps on going. The rabbit hole keeps going deeper if you need it to be.
Alrighty, boss. So this one came in earlier.